Studies Section 5, Balance of Payment. Introduction. When a country engages in transactions with the rest of the world, it is reasonable to document such transactions. The reason for such documentation is to understand the country's position relative to its trading partners and the world. That is, whether the country is indebted to its partners or not. The record of international financial transactions, export, import, capital flows, etc. is called the balance of payment. In this chapter, we shall learn how to record transactions in the balance of payment. We shall also explain each component of balance of payments, which will help us assess the implication of Nigeria's international transactions. Objectives. At the end of this chapter, you are expected to be able to do the following: identify major components of balance of payment, enter transactions in the balance of payment account, explain each entries in the balance of payment, identify issues surrounding balance of payment accounting. Meaning and components of balance of payment. Balance of payment is an account that records the transactions between a resident country and its trading partners. It is the record of economic activities that involve domestic and foreign economic agents at a period of time. If Nigeria prepares its balance of payment, it is the reporting country, while the rest of the world or countries engaging in transactions with Nigeria are the trading partners. Balance of payments are usually prepared annually, but in some countries, such as the US, it is available on monthly basis. Some countries prepare it at quarterly basis. The International Monetary Fund (IMF) compiles balance of payments annually for all countries members, and it is available in the IMF Balance of Payments Yearbook. Balance of payments is an account because transactions are recorded using the basic principle of double entries. Thus, there are two sides to a transaction: the receiving side, credit with a plus, and the payment side, debit with a minus. The receiving side can be thought of as the credit side, while the payment side is the debit side. The inflow of money or capital for the sale of goods, services, properties, or equity are entered in the credit side of the balance of payment with plus, while the outflow of money in respect of such goods and services are recorded in debt side of the BOP with a minus. Thus, the sale of crude oil by Nigeria to the rest of the world will be recorded in the credit side of Nigeria's BOP, because the country receives foreign exchange dollar in return. Similarly, the purchase of manufacturing items from the rest of the world will be entered in the debit side of Nigeria's BOP because the country pays for the good. We see that in each of these cases, money is moving out of Nigeria. If Nigeria receives money for sales of goods, services, and equity, how does it use it? This question requires analysis of how the reporting country makes use of the inflow. For example, Nigeria uses some of the inflow to purchase goods and services, to pay foreign workers, to purchase foreign assets, or lend the money to other countries. The outflow, which describes the use of the inflow, is recorded as debit entry in the balance of payment with a minus, or the figure will be in bracket. There are basically three international transactions that must be recorded in the balance of payment. These are transactions involving export and import of goods and services, current account; activities involving the purchase and sales of financial assets, financial account; activities involving the transfers of wealth, capital account. The first set of transactions are recorded in the current account component of the balance of payment. The second group are entered in the financial account of the balance of payment, while the third group are entered in the capital account. Let us now discuss them detailed. The current account. The current account of the balance of payment is the record of monetary value of international flows that has to do with flows of goods and services, investment in income, and unilateral transfers. Thus, current account includes trade account, balance of visible trade, and services account, balance of invisible trade. The current account balance can be positive, surplus, or negative, deficit, depending on whether export receipts are greater than import payments, respectively. Merchandise goods trade / balance of trade. Merchandise trade include export and import of goods such as agriculture products, manufacturing / industrial products. In Nigeria, crude oil transaction is separately recorded so as to see clearly the role it plays in the current account position of the country. The value of export will certainly be recorded as credit, while the value of import will be recorded as debit. If we add the two transactions together, we will get the merchandise trade balance. The sum could be negative or positive. If negative, it means the reporting country is having trade deficit, and if it is positive, the country is having trade surplus. Services trade. After the transactions in goods, we have transaction in services. Trade in services include all modes of transportation, shipping and get flights, financial services, banking and insurance, etc., tourism and hotel services. For instance, if Nigerian ships carry foreign products such as cars, petrol, light manufacturing products, or when foreigners patronize Nigerian tourist centers, board Nigerian aircraft, patronize Nigerian restaurants, barbing, hair salon, and so on, Nigerian workers who render these services are paid. Such incomes are regarded as inflow of money because Nigerian exports services to foreigners and are recorded as credit entries on the goods and services account. On the other hand, when foreign ships carry Nigerian products, or when US airplanes carry Nigerians to the US, or when Nigerians travel abroad for honeymoon, spend holidays in foreign hotels or tourist centers, or patronize foreign restaurants, the foreigners who provide these services will be paid by Nigerians who enjoy the services. Such payments represent outflow of money due to import of services and are recorded as debit entries in the Nigerian's goods and services account. Insurance and banking are explained in the same way and are recorded accordingly. Other services that should be recorded in the same way include transfer of goods under military programs, legal services, technical services, etc. When we add services to merchandise trade, we get merchandise goods and services trade, or simply the trade balance, which could be negative or positive. If the sum is negative, the trade balance is in deficit, and it means that the reporting country is indebted to these trading partners because it has received so much goods and services from them than it transferred to them. Such indebtedness will be paid for in the future. In this case, the reporting country is consuming future exports currently. The goods and services trade is used to measure the net transfer of resources, and it also provides information about the position of a nation's GDP. This is not surprising since our basic understanding of macroeconomics tells us that the component of GDP from demand side include the net export. The net export is nothing but the current trade balance. If import exceeds export, GDP will fall, while if export exceeds import, net export will increase, and this will increase GDP. The next item in the current account is the flow of income. Some Nigerians have companies abroad, while some purchase part of foreign businesses. The profit, interest, and dividends paid as compensation will be recorded as credit of the current account. On the other hand, foreigners have business in Nigeria, while some of them purchase part of Nigeria businesses. Not only that, foreigners are employed in Nigerian companies. The compensation such as income, interest rates, and profit paid by Nigerians will be recorded as debit entries. Unilateral transfers. Another important item in the current account is the money received or paid without rendering any services or selling any goods. This is called transfer, which could be private or government. Private transfer payments include gifts made by individuals and NGOs to foreigners. A good example of this is the workers' remittances, birthday present sent to friends, contribution to relief funds such as motherless home or juvenile home, contribution to church or mosque development, etc. Government transfer include gifts or grants from one government to another, such as military aid, retirement benefit, pension for people who have worked in foreign countries and have retired. Foreign aid received from these transfers will be recorded as credit entries, while payment will be recorded as debit entries. The addition of investment income and transfer to the balance of goods and services trade account gives what is called a current account. Hence, the current account is composed of the goods, services, investment income, and unilateral transfer accounts. Current account balance could be deficit or surplus. Capital and financial account. Financial account transactions focus on the sales and purchase of financial assets. An asset is any form in which wealth can be held. Wealth can be held in form of money, stocks, factories, or government debt instruments. Capital transactions involve international movement of assets and the acquisition and disposal of certain non-financial assets. It also includes movement of intangible assets such as copyright and trademark, franchise, and leases. Transactions classified as capital transfer include debt forgiveness, migrants, goods, and financial assets taken along as they return home. The acquisition and disposal of certain non-financial assets include the sale and purchase foreign direct investment. When a foreign resident acquires a control ownership of 10% or more in a business enterprise in the reporting country, it is called foreign direct investment. Some companies in Nigeria are in form of foreign direct investment because foreigners own more than 10% of total control. Such firms are in different sectors of the economy such as petroleum, bank, manufacturing, construction, hotels, etc. For instance, there are Chinese and Indian companies in different sectors of Nigeria. There are also multinationals such as USA, Coca-Cola, Beecham Smith Cleans, etc. We should also note that Nigerians have control of ownership of firms in the foreign countries. The latter will be recorded as debit entry, while the former will be recorded as credit entry. Foreign portfolio investment, debt securities. This comprises private sector purchases and sales of short and long-term securities such as treasury bills, treasury notes, treasury bonds. All these are referred to as portfolio investment. Portfolio investment is the smallest of all foreign inflows in Nigeria. The reason for this may not be unconnected with the not very sound financial institutions the country is experiencing in recent times. Bank claims and liabilities. Bank claims are loans, foreign commercial papers, claims on affiliated banks abroad, overseas deposits, and government obligations. Liabilities include certificate of deposit, liabilities of affiliated banks abroad, negotiable order of withdrawals, now saving deposit and checkable deposits. Any inflow from capital and financial transaction will be recorded as credit, while outflow will be recorded as debit. Financial inflow will occur for Nigerian if, for example, a French resident purchases GTB or ETB securities. In this case, Nigerian's liabilities rise since the purchase requires paying Nigerian the amount of the securities. Also, if Microsoft repays part of the loan it took from the sale Dangote Group, financial inflow will occur. Another means of financial inflow is when there is an increase in direct investment in Nigeria. For instance, if foreigners set up refineries in Nigeria or the Chinese build rail networks and manage it, there will be financial inflows. If Coca-Cola sells off its trademark to Nigeria, US claim on Nigeria will reduce, and this raises Nigeria's inflow. The financial outflow implies the opposite of all the examples given above. Let us quickly summarize the entries in the balance of payment. Any transaction that leads to inflow of money will be entered as credit. Any transaction leading to outflow of money is entered as debit. Thus far, we have not mentioned the currency that these transactions will be measured, whether the reporting country currency or a convertible currency such as dollar. In most cases, transactions are reported using domestic currency, reporting country currency as unit of measurement. However, Nigeria uses both Naira and dollar for valuing the transactions in line with the IMF guideline. Having discussed all the major components of balance of payment, BOPs, let us study the balance of payment of Nigeria in 2009 and 2010 as presented in Table 5.1. A comprehensive format of BOPs can be accessed in the CBN Statistical Bulletin or the CBN Annual Report and Statement of Accounts. The format of preparation is in accordance with the IMF format. Table 2.1 shows the entries in dollar value the Naira value is also available. The three basic components of balance of payments are clearly identified in Table 5.1. The value of current account was $13.3 billion in 2009 but fell to $2.5 billion in 2010. The country was able to export goods worth $56.74 billion in 2009, and by 2010 the value of export rose to $74.32 billion. Aggregate merchandise imports were $31.12 billion in 2009 and $74.31 billion in 2010. Hence, the decline in the net export current account balance was informed by largely increasing imports. As a result, the net current transfer, which was $18.9 billion in 2009, rose to $20.26 billion in 2010. Workers' remittances accounted for 95% of transfer inflow, while pension inflow accounted for 4%. Hence, workers' remittances inflow dominated the unilateral transfer in Nigeria. There was no acquisition or disposal of capital in the years, and so no entries in the capital account. Meanwhile, the country experienced net inflow of financial assets. The financial asset of the country in abroad is very small, $1.69 billion, even though the country had more assets in abroad than foreigners had in Nigeria due to the reserve position of the country. Nigeria's direct investment was less than $1 billion, while foreign direct investment was $11.58 billion. Also, Nigeria's portfolio investment abroad in 2009 was less than $1 billion, but rose slightly to $1.13 billion in 2010, whereas foreign portfolio rose from $0.48 billion in 2009 to $3.75 billion in 2010. Table 5.2 gives a summary of the current account position of Nigeria between 2005 and 2010. The country experienced surplus trade balance throughout the period, with the highest surplus recorded in 2008, and since then, merchandise goods trade balance has been falling. In the case of services trade balance, the country experienced deficit throughout the period, with the highest deficit recorded in 2008. However, the surplus in trade balance was more than the deficit in services trade balance, such that the goods and services trade balance, or simply trade balance, was surplus, which has been declining since 2008. In 2010, trade balance fell to $1.02 billion from $8.96 billion in 2009. In fact, the country has been experiencing sharp decline in its trade balance since 2008. Income account balance was also in deficit, with the highest deficit recorded in 2010. The country had just $2.25 billion deficit in income account in 2005, but by 2010 it has risen to $18.78 billion. It should be noted that unlike services trade balance that did not follow a particular trend, deficit income account balance was increasing consistently, with a slight decline in 2009. Unilateral transfer balance was surplus throughout the period, and the highest surplus was $20.26 billion in 2010. Because the trade balance and unilateral transfer balance were surplus, which was so large that it overweighed deficits in services and income accounts, and current account has been in surplus since 2005. But a closer look at the figures shows that the current account balance followed a continuous downward trend, except in 2008 when there was a slight increase. The economic meaning of current account deficit, surplus. There is a link between current account and capital account. Hence, we cannot judge the position of a country relative to its trading partners using either current account or capital account alone. But because of the fact that balance of payment must balance, it must be the case that any deficit in the current account will be offset by corresponding financial and capital account surplus. Current account deficit can be likened to excess spending over income. To offset the excesses, one might draw down its saving, sell off part of one's wealth, or borrow from friends or banks. When a country experiences current account deficit, the meaning is that its international expenditure is in excess of international earnings. How does a country finance its deficit? We have a clue to this before. Just like individuals, such country can sell off its foreign asset or borrow from international financial institutions like the World Bank or the International Monetary Fund (IMF). Recall that borrowing or drawing down foreign assets will appear in the financial account. Does this account pick up any deficit arising from current account? It follows that to examine balance of payment, deficit or surplus, we can classify the entries into accommodating and autonomous items. The autonomous items are transactions that are not caused by the changes in balance of payment. The accommodating items are the entries used to finance any difference between autonomous receipt and payment. When autonomous receipt is in excess of autonomous payment, balance of payment will be in surplus, otherwise it will be in deficit. However, items classified into autonomous and accommodation is not as easy as one could imagine. This is so because the motive underlying a transaction is not explicitly defined in the balance of payment. A good example is financial inflow that responds to high domestic interest rate. This item should be classified under autonomous. Also, if direct investment responds to conducive economic environment, it should be recorded under autonomous items, but it is targeted at correcting current account deficit, it should be classified as accommodating item. We now see that it is somehow difficult to classify items as autonomous and accommodating because of the difficulty in identifying which item should be recorded as accommodating and the trade and current account. Recall that current account records both visible merchandise goods and invisible services, income, investment, and unilateral transfer items. This account is considered to be more important than capital account. We have mentioned before that current account deficit means the reporting country is increasing its indebtedness on the rest of the world, or to say that the country is reducing its claim on the rest of the world. Conversely, current account surplus implies that the reporting country is reducing its indebtedness on the rest of the world or increasing its claim. Hence, the current account tends to quickly pick up changes in other economic variables such as changes in exchange rate, domestic and foreign economic growth. Thus, much attention should be paid to current account balance. The basic balance. Basic balance is the sum of current account balance and the net balance on long-term capital flows. Economists consider the account as more important in 1950s and 1960s during the fixed exchange rate regime. The argument was that any change in the basic balance would signal to the direction of the balance of payments. The more volatile elements such as short-term capital flows and changes in official reserve are, therefore, considered as accommodating items below the line, while basic balance, which contains the stable element, is considered as autonomous item above the line. The basic balance has an important economic implication. For example, current account may be in deficit with large outflow of capital so that basic balance is in deficit, but this may not be a bad thing. Why? Because recall that the long-term capital outflow, loan, equities purchase of foreign business will yield future interest, profit and dividends, and when these are repatriated, it can be used to improve the current account. Also, if the basic balance is in surplus, it does not really mean a good thing. In fact, what it means is that the economy may have problems in the future when there is need to repatriate profit, interest, and dividends back to foreign countries. As good as the basic balance is able to explain balance of payment disequilibrium, the major problem is how to determine the time period of capital flow. That is, how do we identify short-term capital flow from long-term capital flow? A long-term borrowing lending implies loans that will be redeemed in at least a year. But many long-term capital flows can be converted to many rounds of short-run capital flow. In the same vein, some short-term flows with less than 1 year can be renewed several times so that they become long-term assets. appreciation. Thus, when the official settlement is in deficit under the fixed exchange rate, the authority will intervene by purchasing home currency and sell foreign currency so as to avert depreciation. In the case of floating exchange rate, the basic balance will be zero because the system is self-correcting. These three concepts are used by the IMF to prepare balance of payment for some advanced developed countries in 2002 before it extended to other countries. The basic balance concept appears to be the one used by Nigeria because the financial account actually shows how the authorities finance the difference between current account and capital account. Net errors and omissions. This section of the balance of payments accounts for any error or omission that might have occurred during posting. Data collection process is always fraught with series of problems. The cost of collecting data for balance of payments preparation is high and a perfectly accurate collection system will be very costly. Thus, government statisticians tend to base their figures on information collected and partly on estimates. In the balance of payment, the most reliable section is information on the merchandise trade data, which are collected mainly from customs records. Information on capital and financial account is derived from reports by financial institutions indicating changes in their financial assets and liabilities to foreign countries. These data are not matched with specific current account transactions. The reason is that those in charge of computing the data do not have a system whereby they can simultaneously record the credit side and debit side of each transaction. Such information for any particular transaction tends to come from different sources, and by implication, large numbers of transactions fail to get recorded. Although customs records will show the amount of goods exported or imported, payments for these transactions may not be immediate. As a result of this lag and delay, there will be errors in the computation. Furthermore, some exporters tend to under-invoice import and over-invoice export so as to reduce taxes and increase profit. Furthermore, there are some transactions that were not picked up at the time of collecting data. All this must be accounted for. In Nigeria, such errors and omission accounted for $26.57 billion in the BOS in 2009, but fell to $5.48 billion in 2010. We see that the value was negative, implying either the current account or the financial account is overreported and adjustment needed to be made. Such errors and omission is not peculiar to Nigerian case. It occurred in almost all economies of the world, only that the value should not be large. Have to do with purchases and sales of real and financial, which are grouped into direct investment and portfolio investment. The third section is the bank claims and liabilities that record international bank transactions. The statistical discrepancy picks up any difference between the receipt and payment due to some factors such as over-invoicing of import goods and under-invoicing of export, duration gap between the time the goods enter the country and when payment is made. Current account deficit is not really bad but must be financed. All items occurring independent of balance of payment are classified as autonomous, while items used to finance any difference between current account and capital account are classified as accommodating. The difficulties arising from which items should be classified as accommodating and which should be classified as autonomous led to other concepts of balance of payment disequilibrium. These concepts include trade balance, official settlement, and basic balance. Each of these concepts is not without its unique difficulty. This is the end of study section 5. Thanks for listening.